Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with the infamous John Rubino of DollarCollapse.com, really one of the most articulate economists I know that's out there, really digging through the truth. And, if more people listen to guys like John Rubino, there would be a lot deeper understanding of what is fundamentally sound economics versus just artificial and manipulative economics that we're seeing run rampant across the current system. So without any further ado, John Rubino of dollarcollapse.com. John, thanks for coming on Crush the Street.
Hey, Kenneth. Thanks for having me back on.
Well, John, there's a lot of talks about tariffs right now. And, I'd like to jump in there. Obviously the trade wars, it looks like Donald Trump is addressing the imbalances that we've seen around the world. And I found it interesting today. Maybe you saw the news of Tesla wanting to open up a plant in China. And some have even alluded that this is maybe an indirect or just a nudge to do so because of the trade war and to produce cars in China and sell it internally. I'm not sure, but I'd love to kind of get your analysis on what's going on right now with the economy and what's your sentiment towards what's going on with the trade wars at the moment?
Yeah, isn't this funny? You and I've talked about all the mistakes we're making for years and years, but it's always been, oh, we're borrowing too much money and we're doing this and that will lead to some kind of a financial crisis. But we've never had a trade war to talk about. This is a new thing. And I think in one sense, it might be a temporary thing because this is how Trump does business. Historically, he's kind of led with lawsuits when he was trying to get something done. And he's made people's lives miserable until they come back to him and say, all right, what do I have to do to get this to stop? And then they cut a deal. So he has adapted that business strategy to geopolitics. And he's out there attacking everybody, friend and foe alike, and making their lives harder with, I think, the intention of bringing them to the table and getting them to be willing to cut a deal that's favorable to the U.S. So we can see this trade war thing. And at 4 o'clock in the morning, any given night from now on, with a tweet from Trump saying, okay, we're friends with China again. We cut a deal. And I'm going to meet with China's leader and we're going to play golf and we're going to have fun and we're best buds now. And then the whole trade war fear ends. And then we go back to, we're doubling the national debt again, and student loans are this, and subprime auto loans are that. In other words, back to the financial crisis that's looming out there because of all the mistakes we've made in the past. So I think it's very possible that the whole trade war thing is just a distraction that will end pretty soon, and then we'll still be left with the huge problems that we have otherwise. If it doesn't end, and we have a trade war on top of all the other stuff that's going on, that just makes 2019 that much harder of a year. We're going to have a reckoning for all the money that we've borrowed and for all the other mistakes that we've made. And it has the feel of something that's coming fairly soon because of some end of cycle things that are starting to happen now. Wages are starting to finally go up. We're finally entering a period of labor shortages, which is what you normally get at the end of a cycle. But it took a really long time this time around. It took a decade, whereas usually it takes 4 years in a recovery. And that's because the more money we borrow, the deeper each crash is, and the longer it takes to dig ourselves out of it. And so we're seeing the effect of that, where now it takes 10 years to soak up all the excess workers out there and allow them to start demanding higher wages. See, that's a good thing for workers, but it's also a signal that interest rates are going to go up because wage inflation is something that the Fed looks at. They ignore asset inflation. Stocks can go through the roof and bonds can go way up and house prices can go to the moon. Fed doesn't consider that to be inflation, even though it really is. But let wages start to go up and they start to panic and start to raise interest rates. Historically, that's happened and it'll happen again this time around probably too. So we'll have rising interest rates, rising wages that cut into corporate profits. In other words, if you got to pay your people more, that's less left over for stockholders. So we're creating the conditions in which an equities bear market can happen very easily, because all of a sudden stock dividends, for instance, are competing with bank CDs that are higher than the average dividend rate on the S&P 500. And corporations that have been generating record profits the last few years are going to see that profit growth either slow or reverse because of higher wages, which means buying their stock is not a good deal, or as a good deal as it used to be, because their wage or their earnings growth is not as dramatic as it used to be. So, we're creating the conditions for a bear market in financial asset prices, which tends to coincide with a recession, and it could happen fairly soon. This could be a 2019 story.
Yeah,
So,
and it feels like it's almost impossible for anything to turn around. It seems so optimistic. I heard someone on CNBC the other day allude to a 20-year long bull market here. Like a super cycle type 20-year long bull market without any major issue going on. And you kind of get into this momentum, building momentum. Things are seemingly very strong, billions of dollars entering the economy, and wages going up, worker shortage. Everything sounds so good. How could it possibly turn around? And then I'm reminded of the much smaller market, what we saw with cryptocurrency and Bitcoin. Everything just seems so positive. How could anything go wrong? And then as soon as things do, it compounds on each other in the opposite direction. I think that's very possible to see that on a large scale with much larger markets, of course, the stock markets in general. But you mentioned rising wages, worker shortage. Really, it's still so insignificant when you consider how people are living. To start your life in 2018 is much different than trying to start your life in the 1960s or 1970s. The same lifestyle that someone would try to have. You need to have wages of an attorney or a lawyer that would equal the purchasing power of someone in the 1960s or 70s who was a mechanic or a postal worker. And again, this is what we've seen, and this is the real consequences of the degradation and the mistakes that the U.S. has made over the years. And I'd like to just get your thoughts on that, because this is what we're ultimately waiting to unravel. Because we're seeing the writing on the wall. We're seeing other countries rise up, and other countries are taking steps to detach themselves from the U.S. and be prepared for the ultimate, debt crisis that the U.S. would have. And the more other countries separate from that, the more the U.S. deteriorates, the closer we are to all this happening. So with that said, what are some of your thoughts?
well, yeah, the world has changed really dramatically, especially for American workers over the past few decades. And part of that was always going to happen. I mean, World War II left us as the world's manufacturing superpower. So we could set up a factory, pay our people really well to run it, and then sell stuff to the rest of the world. Well, the rest of the world wanted in on that action, and they deserve to be in on it, obviously. So as other countries develop and are able to set up factories and staff those factories with much cheaper workers, we were going to feel wage pressure. It was going to get harder and harder for U.S. high school educated people to make the kind of money they made back when everything was unionized and money was pretty good. That was inevitable. But the way we've dealt with that transition has really exacerbated the problem, because instead of staying lean and mean and watching our finances and not building up huge amounts of debt, we basically tried to keep the same lifestyle and finance it with borrowed money. So you see, historically, going back to, say, the 1970s, you see debt start to increase at every level of society in the US as governments borrowed way too much money in order to finance all the projects they thought were necessary. And as people were encouraged by the government to take on debt themselves. In other words, we pushed interest rates down to abnormally low levels, which encouraged people and companies to borrow more money than they would have otherwise. So we ended up taking on debt at pretty much every level of society, and now that debt is debilitating. So now we've still got the competition from overseas problem that we would have had in any event, but now we've got leverage problems where everybody has borrowed pretty much as they can borrow. And life gets hard when you borrow too much money. Well, we're seeing everybody everywhere in the US feeling the effects of that. State and local governments, for instance, made pension promises that they can't possibly keep now. And that, in effect, is borrowing money in the present against the future. So one of the big crises that are coming, that's coming is pension plans blowing up everywhere in the country and bankrupting a lot of cities and possibly some states. Look at Illinois. They are functionally bankrupt right now. And if they get by for another 5 years without having some kind of statewide financial crisis, I would be shocked just because the numbers are so overwhelming. You've got, let me name a few more debt sectors, Kenneth, for a second, just to complete the thought. Subprime auto loans are at record levels. Student loans are at record levels. Credit card debt is at record levels. Mortgages are approaching record levels that we hit back in the housing bubble days. So you're seeing debt everywhere rise to levels that, if it was just one sector, would cause a crisis in that one sector, but it's everywhere. So we've got a systemic debt-related crisis coming, and it's a problem of our own making. You know, it didn't have necessarily anything to do with globalization. We could have managed a globalizing society, but we chose not to. We chose just to keep on maxing out our credit cards. And now we're going to pay the price that everybody pays when they borrow way too much money, except we're going to pay it at a national level and maybe a global level.
John, so not Austrian thought whatsoever, but is it possible that the short-term to mid-term fix to this is 75,000 point Dow Jones, you know, injecting the economy in such a way that stocks, you know, triple from here, or a double and a half from here, and you know, pension funds are saved, or at least on life support for a little while longer, and the debt crisis and all of these things that we're worried about is now kicked down the road because, you know, valuations are higher and there's more money circulating in the economy as a result.
Well, that's really the question, because they would love to try that. That's the lesson that they learned from the past 30 years, is that you meet slowdowns with massively easy money and inflate asset bubbles, and that gets you through the next cycle. So the question is, can we do that again? Can we inflate another asset bubble on top of basically a global, you know, they call it the everything bubble now, where every major asset class is pretty much at record levels now? And can they do that with newly created currency after they've already created so much currency and flooded it out into the world? And I think the answer is probably not. You reach a point where supply and demand starts to be an actual real force in the world. In other words, you create an ever-increasing supply of new currency. And at some point, people figure out that that increasing supply makes each individual piece of that currency less and less valuable, and they choose not to hold it. As soon as they get paid, they buy stuff with it. And that pushes the price of stuff up. So you get something that looks like inflation as we define it. Price is going up. But what's really happening is people are losing faith in the currency. And at that point, it's game over, because the central bank and the central government have lost the last tool that they had to manage all the debt that they've taken on in the past. When you don't have a currency that people are willing to accept, you can't inflate that currency and use it to buy back assets or to prop up zombie industries or to fight wars. You can't do any of this stuff that we normally like to do with our extra currency. And so you have to live within your means. And in our case, living within our means going back to like third world status in a lot of cases, we would have to cut our living standards by 50% to live within the means that we have now.
Well, and
And
so
that
many
would
things
be,
are based on high prices, right? The fact that home prices have gone up, people have based their expenditures on that. They've withdrawn funds to finance their lifestyle, backed by a higher valued home, or they purchase vehicles and so many things that, again, we've settled into in terms of lifestyle are based on certain valuations, and a revaluation of many of the assets that are out there could be a major shakeup for the current economy. And I think this will lend to that. And I'll let you continue here, but we're starting to see this. We're seeing it. This flattening of the yield curve and a potential inversion of the yield curve. Some people are worried about it. Other people are saying that we're in a different scenario, and even Fed chairman might not be as worried about it as some other people are, based on different metrics in the economy, and things are positive here, but that makes this different. I'd like to get your take on that, and get a little better understanding on what the yield curve is telling us and what to expect.
well, yeah, the flattening yield curve, which if it continues on its current course will invert, which is to say short-term interest rates will be higher than long-term interest rates in another 6 or so months. That's a perfect recession indicator. You go back to World War II, and every time the yield curve inverted, we got a recession shortly thereafter. So that's another end of cycle signal. Wages going up, inflation starting to pick up, the yield curve starting to invert, interest rates starting to rise at the short end. All of that stuff is what you normally see towards the end of a cycle. So it's nothing mystical, magical, nothing really surprising or ideological. It's just how it normally goes after an economy has grown for a number of years. But to get back to the moral hazard that you were talking about, where people's lifestyle choices are dictated by their asset portfolios. And that's a big deal, because if your stock portfolio has quadrupled, like a lot of them have over the last decade, your bond portfolio is way up, your house is 2 or 3 times as valuable as it was when you bought it a couple of decades ago, you feel rich and you feel smart. And you feel able to draw on those assets to spend money that you wouldn't normally spend just looking at your income from your job. So we have a whole society of people out there like that now, where they're spending money based on really a false sense of wealth. Oh, and maybe they have a pension, a public sector pension that's going to pay for their health care, and 70% of their final year's income for life, they think. All of that stuff is an illusion, because when the economy turns down and we have the next financial crisis, asset prices will just evaporate. You'll see a lot of things be cut in half. And all of a sudden, you're not nearly as rich or smart as you were. And then the city or state that's running your pension fund is going to say, oh, you know what? Our stocks are down and our real estate portfolio is down. So we're going to have to cut your pension benefits by a third. And all of a sudden, you don't have the income you thought you had going forward. And that the impact that has on your spending is called the wealth effect. Well, only in this case, it's the reverse wealth effect. When your assets are going down in value, you spend less. And that creates this feedback loop, a negative feedback loop in an economy where things get less valuable, people spend less money, which makes things even less valuable, and so on, until you enter kind of a death spiral, where the bottom is the point where people who held on to a lot of cash and didn't borrow a lot of money come in and start buying super cheap assets. We don't know where that's going to be this time, because relative to the amount of debt that's out there, the amount of cash that potential bottom fishing investors have is pretty minimal. Warren Buffett will jump in and buy $100 billion worth of stuff. Apple will repatriate a few $100 billion and buy a bunch of stuff. They'll do that, but the average person who might have in a different world saved a lot of money in, for instance, a bank CD or something like that, and then would be capable at the bottom of the cycle to take that CD and buy stocks or bonds or whatever, they're pretty rare anymore. So the negative feedback loop, once it kicks in, could be very, very serious this time. Could take us down to levels that are surprising right now. which would be great for people who have cash, or sound money cash, not necessarily dollar cash or euro cash or yen cash, but sound money cash in the form of gold or silver, because those things will hold up when governments start cutting interest rates again and start flooding the system with fiat currency cash, whereas fiat currency cash will go down in value. So the people who this time around or next time around might be the ones with capital, might be the gold bugs, might be people who have a bunch of silver coins buried in the backyard. They dig those silver coins up, find that they're extremely valuable now in terms of fiat currencies, and can use them to start businesses and buy stocks and bonds and get the thing going again. But the point at which that happens is probably a long way from here in terms of asset valuations. We got to fall a long way to pull gold bug savings into the economy, and I think that's what we're going to look at, or that's the place that we will have to be before this thing turns around.
Yeah, I'm right there with you, John. It's powerful principles right there, especially in terms of the prudence for people who will be ready to take advantage and be there when things revalue. And I have a couple potential, and I'm sure you do as well. I'm open for the situation to even play out similar to how it did in 2008, where there's a rush to US dollars in this collapse, right? Because that's what we saw last time. We see a global crisis. It's still very much conventional wisdom to believe that the US dollar is the safe haven. So even if we do see US stocks crash, I mean, that'll be demand for US dollars, and all of a sudden we see that perpetuation of stocks collapse around the world. It's possible that the USD becomes the safe haven once again, and it plays out similar to 2008, but maybe not, right? I mean, anything you want to follow up to on that?
Yeah, I think that is one scenario that is historically unusual, which is the rest of the world is in even worse shape than us. So where is European money going to go, or Chinese money or Japanese money go when those societies get into the kind of debt-driven trouble that they have coming their way? And a lot of it is going to maybe flow to the US. It's possible that as messy as we will be a few years from now, will be less messy than, for instance, Japan, whose government debt is just off the charts, or China, that has basically quintupled its debt over the past 8 or so years in order to build out this massive national infrastructure.
And they got a demographic problem.
Well, yeah. Well, everybody has a demographic
but
problem.
They're a little worse off than the US is.
Oh, yeah. Well, Japan has the worst demographics. Germany, Italy, and a few other European countries are right there with them. And China, they had a one-child policy for a long time because they were wildly overpopulated. And that one-child policy worked in the sense that the generation coming along now into the workforce is smaller than the one that's retiring. And that is it's a potential financial crisis for a country that has made big promises to retirees. But it's also a good thing in a lot of ways. There are too many people. We need to lower our birth rates dramatically. So to the extent that this is happening and it causes a financial crisis, that's a pretty good trade-off compared to the ecological crisis that would come from another doubling of human population, which is what we would have gotten if we'd stayed on the 1950s, 60s, and 70s birth rate track. So the demographic thing is definitely a financial issue. And it's definitely a problem if you are unwilling or unable to scale back Social Security type programs. In other words, the way you deal with a shrinking population is to scale back your promises to the retirees that are around now. So as a baby boomer, I think that's our generation's chance to sacrifice. We never had to do that. We didn't have World War II or the Depression or anything to get through and to show that we're willing to sacrifice for our future. Well, it's possible that the whole retirement thing is going to be our chance. In other words, we might need to raise the retirement age to 75. We might need to scale back Social Security and Medicare by 10, 15, 20, 30%.
Mhm.
And we will do that via inflation, by the way. We won't do it by just cuts in those programs. We'll just inflate away the currency at a rate that exceeds the cost of living increases that we allocate to those programs. So it's going to happen one way or another.
And
And
to be honest, I don't think it's going to happen to the baby boomers. It's going to be spoon fed to probably the millennials. It's going to be okay. Well, we're going to change the retirement age for anyone 40 and under to 7, and maybe
well,
that's too late, right? But I don't think you're going to be able to get that through to everyone who is expecting a paycheck next year, right?
yeah, no, you see that's a recipe for political chaos. If you try to shortchange the baby boomers, because we're big and we're selfish, right? We don't take kindly to anybody messing with our money. So that's going to be a battle, but it's going to be a battle that's generational, because the people who have to pay for us if we don't take a cut are our kids and grandkids who are out there working right now and struggling,
Mm.
and who are together politically more powerful than us even. So they could push something like that through. But I suspect, as I said, the way they'll push it through is just inflate the currency at a rate that's faster than they're giving us cost of living increases. So each year we get 2% less in real terms than we had the year before. And that's hard to figure out. It's hard to understand how and why that's happening, because life gets a little harder, but you don't really know why exactly, as
Right.
opposed to the government coming in and cutting your benefits by 30%. You know why that happened. But if the cost of coffee goes up a little bit, and your rent goes up a little bit, and your Social Security check doesn't quite keep up, that's bad, but it's harder to lay blame for it. So that's how they're going to do it. They're already doing it, by the way.
Already doing it, right?
Yeah.
It's like we were talking about before. It's the same reason why someone needs to be, a surgeon to be able to afford an apartment in Los Angeles, or a metropolitan city in Florida, as opposed to years ago when it was a job where you were holding a wrench, or some manufacturing type of job, and you were able to get by a lot differently. And or for people having to have two people working in the household, that shift alone again is hard to pinpoint, but it really is a degradation of your lifestyle, having to have two people pay the bills instead of one. Hard to really define where that happened, how to compare household earnings till today against household earnings we had 40, 50 years ago. So yeah, John, great articulation there, John. If you would give us some closing thoughts here as we come to the end of this interview. And again, thanks for coming on Crush the Street. And as always, share with everybody where they can find your information, and what they can expect if they visit dollarcollapse.com.
Yeah, well, the dollarcollapse.com is really where you want to go to hear more about this, because that's a site that covers the gloom and doomy dark side of the global financial system. But I would like to leave with the thought that this is an investment thesis, which is inherently optimistic. In other words, there are things you can do to make a lot of money from all of this. Crisis equals opportunity. And the fact that we've got a crisis coming, without a doubt, there's no way we get through this without some kind of a historically horrendous crisis, something they're going to be writing about in history books for the next century. But a small portion of the people who live through it will be enriched by it, because they make the right decisions with their finances. And so that's the intellectual challenge. Knowing that something bad is going to happen is pretty easy and straightforward at this point. You just look at the debt numbers, how much money we're borrowing. We've got a crisis coming, no doubt. But what do you do to protect your family and maybe make a lot of money from this? And that's the challenge. Historically, when things like this happen, shorting the highest flying stocks, for instance, was a great way to make money. And this might be a pretty good time to start looking at shorting Tesla or Netflix. By the way, I'm talking my book here. I'm short those stocks. And a lot of other cyclical companies. For instance, Thor Industries, the biggest maker of RVs, which RVs are huge toys that people buy in good times and sell in bad times. That stock is down hard lately as the market is anticipating people selling their big toys. So that's a sector that you can look at for maybe short sale candidates. There's a lot of stuff out there like that. And then on the positive side, in other words, things that are going to go up, precious metals have historically done pretty well when governments respond to financial crises with easy money. And that's the way it's been in the last few cycles, especially the last one. Gold and silver tanked at the beginning of the 2008-2009 crisis. And then when government stepped in and started bailing out everybody in sight, they rocketed. They were the best performing assets in the financial markets for several years in a row. A lot of people made a lot of money in precious metals back then. I think something similar is coming again, where we have no choice but to inflate away the value of our currencies to get out from under our debts. And precious metals, which are real forms of money that have existed for 3,000 years and can't be inflated away by governments, tend to go up relative to these quickly inflating fiat currencies. So a portfolio of precious metals on the long side and mining stocks to go with the precious metals, and some carefully selected short sales on the short side will probably be a really good way to structure your finances going forward. I don't want to get into any specifics about which companies to short, which mining stocks to buy, but finding a good newsletter writer or some other source of specific stock picks on either side of the market would be a good thing to do right now.
Mr. Rubino, John of dollarcollapse.com. Thanks for coming on Crush the Street with me today. And I hope to, as always, do this again in the very near future. We'll talk current events and just keep people updated on what is going on in the current economy. I wish we got into artificial intelligence a little bit. That's something I've been talking a lot about here. Would have loved to have gone over that with you, but that leaves us something for next time. John, Thanks for coming on Crush the Street.
Thanks, Kenneth. See ya.